And good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer webinar. Joining us today is David Burrows, Chief Investment Strategist and President at Barometer Capital. During this webcast, we will provide you with a brief market overview, and of course, we would be pleased to address your questions at the end of our conversation. You can email me at phastings@barometercapital.ca or send your message via the chat. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Good afternoon, Pam. Here we are, and it's the middle of November. I think everybody's sort of hunkering down to work our way through the next couple of months. I went out this morning early for a run at about 5:45 and was surprised to find it was -5, and it is definitely starting to feel like winter with a little bit of snow on the ground. What I'd love to do today is just quickly kind of run through the progression the market's been working its way through and talk a little bit about what's changing. There are some things changing and what remains the same. We all read the news. We all have been reading about this wrestling match for the White House and the fact that Donald Trump does not want to give up his seat. I think that's sort of an inevitability. We are also reading about COVID and the vaccines, 2 of them over the last couple of weeks, which is certainly a good news. Not that it's going to change things in the very, very short run, but certainly it allows investors and all of us alike to kind of look through this next few months to see what things may look like kind of going forward. So let's just talk a little bit about markets. About 3 weeks ago, we talked about the fact that when you have a strong third quarter, most often fourth quarter comes in pretty strong. And certainly, we are moving in that direction. We talked about the week before the election, the fact that we had a lot of uncertainty and that we would have some bumpiness, but that we thought we were at sort of the point of maximum uncertainty. And when I say that, I say it because investors, of course, hate uncertainty. If we wait until there is certainty, inevitably you are too late. But we thought that we were probably at that maximum point of uncertainty, and thought over the next couple of weeks we would start to get a little bit more clarity as to the outcome for the election, what may be happening on the vaccine front, and get a better picture of how the earnings had come in sort of for the third quarter. At that point, all of our sort of long-term indicators were red, meaning that breadth in the market had generally been weakening over the prior month, although the short-term indicators had started to turn green and improve. And these are all measures of breadth, or the percentage of stocks that are performing well. If we move ahead, we had some of our intermediate term indicators turn higher. We saw things that would point to better sledding ahead, some rise in the 10-year bond yield, which tends to point to higher expectations for growth moving forward. We saw copper starting to outperform gold, more economically sensitive of the materials. And we saw the regional banks start to wake up a little bit. And of course, this was from a long, dark winter. Banks had significantly underperformed. Probably only worse group was energy. And as we move forward in the week of the election, we started to see the long-term indicators turn up just prior to the election. At that point, when the election took place, when we talked last week, we talked about the fact that there was a little bit less uncertainty. It looked as though things were getting a little bit clearer. So here we are a week later, and we have long-term indicators in the US and globally positive for equities. Our short-term indicators have all improved. The percent of stocks trading above their 50-day moving average has been working its way higher, quite significant in the US. Percent of stocks with positive weekly price momentum or upward trajectory expanding, now close to 80%. Percent of stocks making new highs versus the percent of stocks making new lows, continuing to improve. And the very longer term picture, percent of stocks trading above their 150-day and 200-day moving averages, moving up over 80%. Now, some people have asked over the last week, well, when 80% of stocks get above their 150-day moving average, does that mean we are getting long in the tooth? And we'll address that kind of as we go through the call. Now, as it happens, the reason you have to be positioned before things happen is because everybody tries to get through the door at the same time. And we know that in the last week, there have been just some extraordinary flows into equities. And that has benefited lots of different groups. There also has been money moving around from one place to another, maybe from the things that people were hiding in for more safety to things that might benefit on the other side of a vaccine. But definitely the flows have not been insignificant. So if we were to look at the S&P 500, for some time we were in that sort of consolidation through October into the beginning of November. Remember, we talked about we could break one way or the other, either lower or higher out of this wedge. We broke higher, and that sort of followed along. So over the last couple of days, just kind of consolidating a little bit, but really from all-time highs. Now, on the day after the election, the market rallied like crazy and then sold off through the day and closed near the lows of the day. And that was as some of the very heaviest of heavyweight stocks were sold. A lot of the FANG stocks that were seen as being quite predictable, a lot of the big growth stocks that people had been hiding in. And they moved into things that were a little bit more economically sensitive, that might benefit from some relative calm in the world. If we look at the NASDAQ, you can see it even greater. That big move up, closed at the low for the day, and then sold off for a couple of days. And one of the questions was, is the move in growth stocks over? Is the leadership going to change? We're going to try and address that a little bit today. But through the course of last week, NASDAQ marked its way back higher again and basically closed flat for the week. But that Monday was a real shocker, because I guess it was Tuesday, because I think lots of people saw the indices up and were wondering why most of their stocks were down. And that's because most of the stocks that have been left for dead, the most economically sensitive, caught a bid, and the really predictable growth stocks were sold by some investors to move into things that had been left behind. So here's a quantification of that. If you were to go back over the last several years, the degree to which those FANG stocks underperformed is unprecedented over the last 5 years. Now, it didn't last very long, but certainly it was not a very fun day on the Tuesday, and then of course things bounced from there. So what benefited? Well, the industrials benefited, and this is the Dow Jones Industrials. This is as of this afternoon, a little bit weaker close today, but look, we're trading right at the top end of the range, and for the first time, trading above the levels we were at in February of this year. So the industrials really lagged, but really caught a bid in the last 2 weeks, and certainly finished pretty strong over the last couple of days. The thing that really has won is the Russell 2000. So there's so many different indices. They all mean different things. The Russell 2000 is made up of, just under 2,000 companies, public companies in the US. They tend to be more sort of mid-sized companies that are more exposed to the US economy. They're a little more economically sensitive. There's a fair amount of financials exposure in here. There's some energy exposure in here. But this group and this index really lagged. It more represents kind of the average stock. And it's nice to see, for the first time in some time, the average stock outperforming just the very largest companies that everybody has been crowded into. And that's important. It's important that we always talk about the concept of breadth. We want to see more and more companies in the market participating in a rally as opposed to a narrow focus in a small number. Let's take the lens out a little bit further. What we can see is that the S&P last week, when it rallied, the percent of stocks trading at a new 20-day high hit over 70%. Now that's important, because that tends to happen at the beginning of a significant move. So we saw that happen here back in early 2019. We saw it happen at the very end of 2018. So these are kind of important points, because that's kind of a bullish indication. Now let's go a little bit further. We talked about the fact that some of these stay-at-home stocks underperformed for a few days. And in fact, they had been underperforming coming into the election as some money had been rotating. We talked a little bit about that. And that took place over about 3 weeks. So how long can these other groups perform well versus the big name growth stocks? Well, we can see that they have significantly underperformed leading up to this point. So the fact that they've had some outperformance really is no indication that this is done. This is probably early stage and can go on for some time. But if it's a healthy market, both growth stocks and value stocks should be able to rally. And in this environment, we can build more diversification into portfolios. We can be broadened out through different groups rather than being quite narrowly focused, jammed into the same stocks that most people own. So what's an indication of that? This is a chart of the value line arithmetic index, and that's a mouthful. But the value line arithmetic index is all US stocks equally weighted. In other words, we're not giving a very large sized weighting to Apple and Amazon and Netflix and Tesla. We're giving every stock the equal weight. And what you can see is that for the first time since December of 2019, the value line arithmetic index made a new high. So that's kind of important, especially because when you take the lens back, actually you have to go all the way back to 2017 when they peaked last. And then they went through the 2018 sell-off, the 2020 sell-off, and we just made a new high. So I often talk about secular bull markets, and secular bull markets and bull markets in general go through periods of several steps ahead and then a period of consolidation. And the value line arithmetic index went nowhere for 2 years. And now it's just broken out. That tends to be when that takes place, you have a significant run in front of you, like we did back here 2011-12, like you did after the 2000, 2008, 2009 bear market, like you did after the 2000 through 2003 bear market. So that's another positive thing, meaning the broad market is now participating. Volatility continues to fall. So this is a measure of volatility. People pay up for volatility when things get shaky. This was the huge spike in volatility in February and March. We've had a number of little quakes since then, one in June, one in August, one in October. But what I want to point out is that volatility has remained elevated all through this year as we've gone through this COVID situation. And volatility is still 93% above sort of the average price of volatility through 2019. So why is that important? Well, when volatility falls, it means investors are getting a little bit more comfortable. It tends to mean that the waters are calming. And when volatility falls, markets tend to do pretty well. So here's a quick chart. When the volatility is below 20, where we just are right now, if you look forward, the percent of months with positive returns when the VIX is below 20, 78% or 77% of months are positive. And you can see during those periods, very significant cumulative returns. If we look at periods where it's between 20 and 25 or higher, only 50% of months are higher. And the cumulative return over a long period, much lower. When it's between 25 and 30, almost no return, 30 to 35, negative returns, 35 to 40, minus 13, over 40, 30, minus 37%. This is the space we want to be in. We haven't been here since 2019, and it looks as though we are headed into a lower volatility period. Now, I talked earlier about the fact that we had a high percentage of stocks trading above their sort of long-term trend lines. And does that mean that the rally is close to done? So if we look back right now, about 84% of stocks are trading above their very long-term trend line. And when that has been the case in the past, 1 week out, it was positive 72% of the time. So certainly you can get pullbacks of 2-3%. 1 month out, you're up 82% of the time. 3 months out, since 1987, up 100% of the time. 6 months out, up 82% of the time. 9 months out, up 72% of the time. 1 year later, up 91% of the time. 2 years later, up 91% of the time. So low volatility, a high percentage of stocks participating. This is very, very, very healthy. Now, we all know the things we should worry about, but there are things on the other side. We have very significant monetary and fiscal stimulus. Likely, we'll see more fiscal stimulus over the next couple of months. We have 2 vaccines with over 90% efficacy, and that will take time to roll out, but markets look 6 to 9 months ahead. And arguably, if there's a good chance, a significant percent of the population 9 months from now will be vaccinated. So there are some real positives. Also, the savings rate has gone way up, and there's close to $5 trillion sitting in cash, where people have been afraid to be in the market, but you can see in the last week starting to work their way back in. So then the question is, when you start to see some rotation and things start to get better, is it the groups that have been leading up to the point where the change took place that continue to lead the market? Or is it the groups that were left behind that people go back and buy that take over leadership? And while nothing is cut and dried, when you got to a point where 84% of stocks were trading above their long-term support, 12 months out, the highest momentum stocks, or the ones that were leading going into the change, were up 90% of the time, 12 months later. The companies that had low momentum, or were the laggards going into the turn, are also positive, but not nearly with the same statistics. So it's not to say that we don't want to broaden the portfolios. We do. But we also don't want to abandon the things that have worked up to this point, things like various groups within technology. So we are straddling both sides of the fence. You know that over the last 6 weeks, we have been rotating the portfolio to some degree to groups that had been lagging but are starting to perform better. But we don't want to leave all of those leading stocks that have brought us to this point. Sentiment certainly improving, and it's not at the area where we would start to get really concerned. A lot more bulls, people getting more confident. But again, there's lots of cash on the sidelines that can get put to work. So let's go beyond the US, because we know we've been focused in the US. We know the US has been the leading market in the world. But if you take the concept of breadth in a market, meaning more and more stocks performing well is healthy, if you take an asset class, you'd like to see that more and more geographic regions around the world are participating. And it's not just the US. So this is an ETF that is the URTH iShares MSCI World ETF. So this is a broad basket of global companies just made a new relative and absolute high. So that is the rest of the world participating, not just the US. So we're also focused on this election, and certainly we're focused on COVID, but it's not about just the US, it's about equities as an asset class performing well relative to other asset classes. Bonds have now been selling off for several weeks, and money is starting to find its way more into reflationary assets, things you would want to own if rates were going higher, and long-term rates have been going a little higher. So let's look at some other markets and take that concept of secular bull markets. The Chinese stock market has been in neutral since 2015, 5 years, and just recently broken above that range, much like the S&P did in 2013, kicking off the next 6 years with interruptions. But we've just come out of a bear market in China, very early days. We talked about Taiwan a couple of months ago. It's been in a range since 1999, and just recently over the last few months broken out to the upside. That's a new secular bull market. The Japanese stock market, you may have followed in the last little while. This is just 2018-19, just broke out to a new high and very strong over the last few weeks. But let's take the lens back. It's just broken out of a 30-year bear market. So equities around the world are looking more constructive. The US, which has been the most disruptive economy on the planet, the greatest percentage of technology, broke out years ago. The NASDAQ broke out in 2016. Taiwan broke out early this year. You've got Japan breaking out. You've got China breaking out, improving breadth around the world. This is emerging markets making a new high. So we like as investors to have choice. We like as investors to be able to diversify. If we're going to be in an asset class, we'd like to own several sectors if we can. And within those sectors, we'd like to have lots of choice of companies to invest in, always looking for the things that are good, getting better, that can be revalued versus their peers. But there is no shortage of things to look at right now in the equity asset class. In the S&P, the Dow Jones, we broke out in 2013 after a long sideways period. Those other markets doing this are not too different. So we can see when we look around the world, all of the countries on this chart that are in green are showing improving breadth. That's constructive, lots of choice. Most of Europe, most of the Middle East, all of Asia Pacific, Latin America, major markets like the European markets, Germany, France, the UK, all looking quite interesting. So let's get down to the sectors. So what brought us here was technology. And you can see that semiconductors continue to perform well, the basic building block of the world's economy. And this is an index, an equally weighted index of a broad range of semiconductor companies. And certainly it pulled back on the Tuesday and into Wednesday, but straight on to make new highs. Interestingly, equal weight technology, if you take all technology companies and equally weight them, just made a new high yesterday. But other groups are now participating, right? We talked about industrials over the last few weeks. And after lagging, still well below the highs from last February, in the last 2 weeks really blasted off, and the relative price performance versus the rest of the market started to improve. This is important. It includes robotics and automation, big themes for us. It includes transportation, some of the rails and some of the truckers, and over the last few weeks, a few airlines. Metals and mining, basic building blocks of the global economy, after trading sideways well below the highs from February, blasted off over the last couple of weeks. Very important. That's not just very large companies like Rio Tinto, but some of the mid-sized companies like First Quantum or Hudbay Mining. Okay, so beyond mining, regional banks. Same thing, some improvement in rates, higher long-term rates, very good for banks. Expectation of a vaccine being successful, very good for banks. Still sort of 17% below the highs from last year, but definitely making a nice turn. They probably have some more work to do, but companies like Regions Financial, Silicon Valley Bank Corp, we own Bank of America, certainly this group getting better. Alternative power, lithium battery power, wind power. We own NextEra, which has is the largest utility in alternative power. The various sources of alternative energy performing particularly strongly, certainly helped by a Biden election. And we talked about dividend growth as the income theme. So as you know, we run lots and lots of income money, and our focus over the last few months has not been so much the high dividend payers, and it has not been fixed income, but it's companies that are a little more economically sensitive with the ability to grow a dividend. And they certainly have had a boost here over the last little bit. So we're pretty happy with the way that we are positioned. When we take a look at the US dollar, we've talked about how the US dollar has been weakening. That tends to be good for riskier assets. People hide in the US dollar when they're really nervous. US dollar backing off allows people to take, is often people taking money and looking outside the US at some other markets. And certainly we've seen improvement there. US dollar really, as of today, is sitting right on the recent lows. My guess is we probably break those lows and head lower. So that means a couple of things. as the US dollar is weakening, Canadian dollar is firming a little bit. In our pools, we have had our currency hedged back to Canadian dollars, so that not having a negative impact on us, but it's certainly helping certain areas like metals we just talked about. And certainly this is an area that we're focused. Now, one area that we do have some exposure to that's been consolidating is some precious metals. They had a very long period of underperformance, strong period over the last couple of years. They've been pulling back. Guess is that's a consolidation. As the US dollar weakens, we're likely to see those reaccelerate to the upside. And a good indication of that is what's happening with Bitcoin. And this is a chart, a long-term chart of Bitcoin, like silver and gold, went through a period where it consolidated, but it's already turned and broken out and headed higher. And so we think it's very possible you're going to see gold and silver follow along with that. So just from a sector perspective, technology from a month ago is a lower weight in the portfolio, still quite substantial, close to 20%. This was, at the end of summer, in the mid 30% range. Industrials are a larger weight in the portfolio, more economically sensitive. Materials, which includes agriculture, metals, and gold and silver, about 11%. Consumer discretionary is about the same. We bumped up a little bit of utility exposure, but it's specifically alternative energy. And we have just slightly more healthcare. So not major changes. We're not completely shaking up the portfolio. We think that our focus on sectors that are going through structural change, where there's disruption, where the themes can lead to revaluation, we're staying there. The portfolios, I would say, are a little bit more focused on mid-sized companies from the very largest companies. And we are broadening out from a geographic perspective. We have exposure in China, we have exposure in Japan, we have exposure in Latin America, and that's likely to continue. So markets can pull back for 2 or 3 days. Certainly right now, we think that the longer term picture is quite bright. Seasonally, we're headed into the seasonally strongest period. We're going to continue to get news on this election. There's bound to be some bumpiness there. There's going to continue to be certainly economic concerns around COVID, something we're staying very focused on, and companies that are doing well going through this period. If things start to back off, we certainly will get defensive. But right now, we are not defensive. We are pretty fully invested. And we think that all of these indications give us reason to be optimistic. And with the rate at which governments are printing money, cash is probably not an option. They're devaluing currency. Bond prices have been falling. That's not probably a great alternative. We want to own things that benefit from reflation, and that's where the portfolios are focused. So with that, Pam, I'd be happy to answer any questions that might be out there.
Thanks so much, David. Would you be able to comment on tourmaline? I know you really liked tourmaline oil last week. Can you explain perhaps the spin out of Topaz and whether you think that's a healthy dividend or not?
Okay, so I'm going to have to leave that one for another time. We'll get Brian, who's the analyst on tourmaline.
For sure.
But our focus in energy has been in 2 places. Certainly alternative energy. And you know that NextEra has been one we've been focused in for quite some time. And Jim Skatakis has done a wonderful job having us in that position. From a traditional energy perspective, our focus has really been in a couple of the gas producers, and tourmaline falls into that camp, as does ARC. And those are sort of 2 significant positions for us. And the reason for that is that conditions have been so difficult for the gas producers. Whereas there might have been 7 or 8 years ago, 200 public gas producing companies, maybe in Canada today, 5 significant ones. So it's been survival of the fittest. and with the energy sector doing a little bit better, we want to have a little bit of exposure to those strong, well-managed companies. But maybe we could have Brian come on and talk a little bit about that, or we could go back to the client directly, specifically on that transaction.
Yes, absolutely. Dave, would you be able to comment? I know we spoke briefly about Bitcoin, and we're seeing that as an emerging asset class. Would you be able to comment on the latest news about Bitcoin in China, that the Chinese are looking to establish their own form of Bitcoin and tie that to the Chinese yen?
Sure. So look, there are a number of cryptocurrencies, all of them using blockchain technology. There is some discussion that the Chinese would like to come up with their own solution. We have focused specifically, and we do have a small position in our pools in Bitcoin itself. And that's because we do think that we are going to continue to see pretty significant sort of devaluation of currency. And while that's certainly not the only place that can give us protection, it is one place. So we're focused there. I think you should expect to continue to see developments in this area. It's still, even though it feels like it's been around for several years, very, very early stages. Institutions are only just starting to use this as an asset class in their portfolios. And we're still early stage in using it ourselves. But I think that in general, paper currencies around the world are vulnerable. And so there's good reason for the use of them. And the question is whether they can get to scale. And Bitcoin to us is the one that we want to have exposure to.
Thanks so much, David. Another question on emerging markets. If you were looking for an ETF, what ETF would you look for if you wanted to get invested in emerging markets?
Great question. There is, the most ubiquitous ETF would be the PIE, which is a technical leaders ETF. So it's actually actively managed. See if I can put it up on the screen here. Yeah, it's actively managed. And so it's not just a basket. Let me just see if I can get it here. Can you see that on the screen, Pam? Can you see my screen?
Sorry, it was muted. Yes, I can. Absolutely.
Okay. So PIE. So this is sort of year to date. If you were to go back over 5 years, you can see, boy, a tremendous valley going through the sell-off in the early part of the year. Then we consolidated and we're kind of broken out to the upside. You can see still seeing trading well below the highs from 2018. EEM is another, again, it's broad-based. I like to be a little bit more targeted. There is, see if I've got it here. You can take a look at certainly the Taiwan ETF. I think that exposure here is something that's quite interesting. Obviously not an emerging market and quite tied to the semiconductor industry. For Japan, you can use EWJ, which is just in the process of breaking out. That's currency unhedged. If you want to hedge currency, you could look at DXJ, which is currency hedged back to US dollars. But those would be some good ones. ILF gives you exposure to Latin America. I think that's much earlier stage and probably not the one I would be focused on. And then China, ASHR, would be a broad-based China ETF, and I think that looks quite attractive also.
Thanks so much, Dave. Another question here. Given the rally we have seen in the past few weeks and our relative small exposure to REITs, energy, and financials, would Barometer look to add to these areas on a pullback, or do these areas look fully valued after their recent rally?
Yeah, no, I don't think that they're even close to fully valued. It will take some time for them to become sort of true leadership in the market. You can see, for instance, on the bank ETF, this was the breakdown that took place in February and March. And this is the long-term moving average still sloping downward. It's going to take some time and probably would have an opportunity to add to them maybe 10% lower than where they are now. We'll likely see them chop around a little bit. And so these groups, I think, it's a great first move, but I think that it's going to take a little bit of time for them to become more consistent. If you take a look at energy, for instance, same thing. There's still lots of work to do here. So you have to pick your spots. And as you know, in the majority of the portfolios, we're rifle shot. We're trying to find very specific companies. So if you take the regional banks ETF, KRE, that's looking better. But if you look at Silicon Valley Bank Corp, much better. Or Regions Financial, much better. So we're trying to rifle shot and pick away at them as you want to buy these on pullbacks.
Final question for today, Dave. Lithium, any thoughts?
Well, we have a 5% weight in the ETF portfolio, LIT. It's one of the stronger performing ETFs. So certainly we do have some exposure there. This Tesla is a beast, and you can see it's just broken out of this range when they announced going into the S&P. Actually broke out just prior to it and had a very big day today. The whole area of alternative of electric cars and batteries is one that's going to go on for some time. So it's certainly an area we want to take a look at.
That's great. Thank you so much, Dave. Well, that concludes our questions for today. And of course, we'll be back next Wednesday afternoon. And if you have questions you'd like David to answer in the interim, please don't hesitate to reach out. You can email us at phastings@barometercapital.ca or pick up the phone and give us a call. David's always happy to speak to our clients and any prospective investors. Dave, I know you called for people to deploy capital last week. And certainly after the call, we got some phone calls about that. And we were doing a lot of trade tickets, buy tickets last week, which is always fun. Do you have any final thoughts you'd like to
look with? I think that this move in the value line geometric index is a big deal. And it's not just the US stock market lifting, it's equities as an asset class. We've lived through 35 years of disinflation, and I think that we are seeing a shift. And if that's the case, with fits and starts, equities are going to be a great asset class for years. And dividend growth is going to be a great theme for years. We've lived for years with the theme high dividend, low economic sensitivity. The move forward is going to be about dividend growth and a little bit more economic sensitivity. Some would say that the Roaring 20s kicked off after the pandemic of 1918. Now, I don't know about you guys, but I can't wait for this to be behind us. And I'm not saying it's anytime soon, but I think when it happens, the amount of travel and the amount of consumer spending is going to be significant. And it could unleash a real lift in the economy. And I think the market is sensing that. And we can't wait till that's the case. We have to be positioned and invested now to take advantage of that as we will inevitably come out of this crisis. So thanks very much, everybody, for tuning in. Certainly, if you got any questions or want to talk about things, I'm happy to jump on the call at any point. Our team is working really hard. And interesting in a market where sort of some smaller and mid-sized companies are starting to perform well. The team is finding some great positions that are lifting quite nicely, and we look forward to the next number of months.
Thanks so much, everyone. Thank you, David.